Tensions in the Middle East are raising concerns about an outright regional war. This follows Israel's killing of Hezbollah's leader, Hassan Nasrallah, who was revered not just in Lebanon but in Iran and other parts of the Middle East. And with Israel not retreating from its onslaught on Lebanon, there are concerns that tensions will only intensify. If the worst fear occurs, what will this mean for the oil price, supply chains and the wider global economy, not to mention inflation? Well, I'm joined by Dr Azar Jammine. He's a director at Econometrix. Thank you very much, Dr. Jammine, for joining us. So the situation in the Middle East is looking exceedingly fragile, and I see that this is already translated in the oil price that we're reporting today. With rising tensions, can we expect more upward pressure on crude oil prices, which of course would then have a knock-on effect on fuel prices, which we're reporting are going to be down come Wednesday?
You're absolutely correct in highlighting the fear of rising oil prices as a result of the tensions in the Middle East. What has been conspicuous, however, in the last few months is the absence of material increases in oil prices in the face of the turmoil in the Middle East. Even though you mentioned that oil prices have crept up, they've crept up marginally in the last couple of days. They're still well down on where they were 4 months ago. And as a consequence, simultaneously, the rand has strengthened. So right now, I think it is far too early to raise alarms about the potential for a reversal in the downward trend of fuel prices. Oil prices have been coming down mainly because there's been a perception that the Chinese economy is weakening and the potentially also the US economy are weakening, and as a consequence the demand for oil is likely to be quite low, and as a consequence there's no need to really fear a particularly sharp rise in the oil price. In addition, OPEC plus, that's OPEC plus Russia, have intimated that they are thinking about increasing production rather than reducing it, despite the lower oil price.
Yeah.
So I'd like to just appease fears at the moment and just rejoice in the fact that for the coming month we will be paying 20% less for our fuel than we were a few months ago.
Yeah, no, that is very positive indeed. But unfortunately, with conflict situations, they're very fluid and things can change very quickly. If there is a wider conflict, what are some of the economic impacts that you foresee? And could we see the improved global inflation picture reversed, which in turn would reverse the prospects of continued interest rate cuts?
Undoubtedly, if this conflict were to spread, and you intelligently highlighted the potential impact that such a spread of the conflict could have on supply chains, on shipping routes, then suddenly there is a shortage of oil supplies and the price could rise very sharply. But we're nowhere there as of it now. There are fears that Israel may invade Lebanon to follow up and take advantage of the gains that it has already made. Even that would not necessarily disrupt supply chains. So it really requires an Israeli attack on Iran or something similar to that, of that order of magnitude, for us to see a reversal in the downward trend of oil prices.
What about the capital markets? I mean, even when things are really bad, like during the COVID years, when things were bad economically, markets were actually doing quite well. You know, if there was to be an out-and-out regional war, who would be the winners and the losers in terms of markets?
Well, this is quite an interesting question, and what has been noticeable in the last few weeks is the way in which equity prices in many countries around the world have been hitting new all-time highs on the expectation that lower economic growth around the world, including China, may lead to lower inflation and therefore much lower interest rates. And that's very good for financial markets because it means that profits of companies can increase and the discount rate at which those profits are valued today also rises. If there were, but you're quite right, if there were a complete conflagration, I think the effects could be negative. But there is an alternative, it's a very cynical view that says these wars are the fodder for the American military, and for that matter, the European military machines and factories to really start producing in a big way. And so in some perverse way, they're actually assisting in providing additional economic activity that is positive for the markets. Ironically, if you think back to that massive invasion of attack on Iraq by the United States in 2003, the market actually hit a bottom the day shock and awe began. And from then on, we had a bull market because people figured that now American factories would start making more and more machinery and armaments to actually feed the Iraqi war.
Yeah.
So it's not at all clear that there would be a devastatingly negative effect on markets.
And then just speaking to the domestic fuel situation, we've heard the news that we're going to experience petrol prices of over 1 rand per litre. This is the 5th consecutive decrease. You did say 20% decrease, relative perhaps to last year. Just give us your thoughts around what sort of impact you expect this to have on households and the wider economy.
Undoubtedly, it is going to provide a little bit of a breathing space for households, especially poorer ones, in that they will have a little bit more available to spend on everything else. And this should prevent the economy from going into recession. And in addition, there is now little doubt that the Reserve Bank will be pressured to decrease interest rates still further when its Monetary Policy Committee meets again in November, because with fuel prices at their current levels, we could be looking at an inflation rate of no more than 3.5% in a couple of months' time. That's barely above the lower end of the inflation target. Now, the Reserve Bank's not going to go crazy and cut interest rates massively, but further reductions in interest rates will provide additional breathing space for consumers. So it's not only the fact that they will be paying less for their fuel, but also they'll be paying less on their debt as a consequence of this. I should caution, though, against believing that this is now the beginning of boom time. There is still a lot of headwinds to confront in the coming few months, but at least it is a positive outlook, and one that has already been improving in the last few months as a result of the formation of the Government of National Unity and the perception that the GNU will attack some of the structural problems facing the economy that are restricting growth. One example where we've already seen some significant progress even before the GNU is the absence of load shedding over the last 6 months. So yes, it is good news, but just see it more as breathing space rather than the start of a big boom in the South African economy.
One last geopolitical related question. The South African government has been very deliberate in courting the West and the East in looking to further the country's economic fortunes. If a Middle Eastern war scenario becomes a reality, with Iran, of course, being a member of BRICS, and of course, South Africa is a founding member along with Brazil, Russia, India and China. Do you think countries that are associated with Iran will then be penalized? I mean, we've just had our government come from the United States trying to push that we remain in the AGOA and continue to have more investment and relations with Americans.
I think the situation is far too complicated, complex for any country to start penalizing another country for being supposedly perceived to be in alignment with some other grouping. For that matter, there are many people in the West who would probably be sympathetic towards a stance by South Africa that aligned itself with the BRICS countries. There is a lot of criticism of the West for not taking enough sufficient action to stop the conflagration taking place currently in the Middle East.
Thank you so much, Dr. Azar Jammine, for your time. He's a director at Econometrix.